If you think the housing market is stuck simply because mortgage rates are high, then you're only looking at the easiest part of the story. The real problem isn't interest rates themselves. The real problem is the set of structural issues hiding underneath those rates, issues that are quietly freezing the market from the inside. And until those problems are fixed, even if rates come down, housing will not return to anything close to normal. Yes, mortgage rates matter, but blaming rates alone is like confusing a fever with the disease itself. Rates are just a thermometer. They show the temperature of the market. The actual disease lies elsewhere, in supply behavior, affordability structures, and the true monthly cost of owning a home. Even if the rates drop by 1 full percent tomorrow, the market would not suddenly become healthy, because today's core housing problem is about trust, mobility, and total monthly payment pressure, not just interest rates. The biggest structural break in housing right now is seller lock-in. Millions of homeowners are sitting on mortgages in the 2 to 4% range. If they move today, they would be forced into new loans closer to 6 to 8%, which means a massive jump in monthly payments, even if they buy a similarly priced home. For example, someone with a $400,000 mortgage at 3% would face a life-changing increase in payments if they moved to the same price range at 7%. That's why people aren't moving. And when sellers don't move, inventory gets choked. The result isn't a crash, it's a freeze. Prices stay sticky, but transactions collapse. Today's affordability problem isn't just that home prices are high. The real issue is that income growth has not kept pace with home prices and monthly payments. Housing affordability breaks when the ratio between a buyer's monthly income and monthly housing cost moves outside its normal range. The emotional reality is simple. People can't qualify, they can't save enough for down payments, and even those who do qualify feel financially squeezed. Demand hasn't disappeared, it's trapped. This is where many people get confused. They see rates stabilize or decline slightly and wonder why housing doesn't improve. The reason is that mortgage interest is only one part of the payment. Insurance premiums, property taxes, and HOA fees have risen so much in many areas that they absorb any benefit from lower rates. When insurance and taxes keep increasing every year, your all-in monthly cost doesn't go down, even if rates do. The impact is clear, buyers pull back, investors lose margins, and homeowners feel squeezed. The real rate that matters is the total monthly payment. Sometimes it looks like more listings are hitting the market, yet housing still doesn't feel healthy. That's because the quality of inventory has changed. Many listings are overpriced, problem properties, poorly located, or still unaffordable on a monthly basis. A healthy market doesn't just need more listings. It needs the right listings at the right price and payment level. In today's market, buyers fall into two main categories: cash buyers or high-income high credit borrowers, and payment-sensitive buyers, who make up the majority. In a high-rate environment, that second group gets pushed out. When the majority of buyers are eliminated, the market loses depth. Without depth, the market becomes fragile. Even small negative news can shut activity down. Sellers hesitate, buyers wait, and the freeze continues. So, what should you do? If you're a buyer, don't wait for the perfect rate. Your priority should be controlling monthly payments and maintaining flexibility. Negotiation power shows up when sellers are motivated. And in frozen markets, motivated sellers do exist if you know where to look. Focus on seller credits, price reductions, repairs, and buying with margin. If you're renting, understand that housing freezes affect rentals too. Build a plan with a 12-month runway, savings discipline, and location flexibility. Your advantage is speed, being ready to move when opportunity appears. If you're a homeowner, your 2 to 4% mortgage is a golden handcuff. Don't base move decisions on price alone. Focus on the total cost of change. Consider renting out, downsizing later, or staying put until a real trigger appears. Today, housing game isn't about timing rates. It's about managing the entire cost system. Most people focus on rates because they're visible. They're easy to point at. They move every week. But housing doesn't freeze because of one visible number. It freezes when incentives break, when people stop trusting the math, and when moving from one home to another feels financially dangerous. That's where we are right now. Before we go further, one important clarification. This is not a doom video. This is not a crash prediction. Housing markets done a T always break by collapsing. Sometimes they break by slowing down so much that nothing works properly. And slow damage is often more confusing and more dangerous than fast crashes. Insert after rates are a thermometer explanation. Historically, housing recovers when people believe that making a move won't punish them financially. Right now, that belief is gone. Buyers fear overpaying. Sellers fear losing their low-rate mortgage. Lenders fear weaker credit quality. When fear replaces confidence, even lower rates fail to restart activity. There's also a psychological layer to lock in that rarely gets discussed. Homeowners don't just compare numbers. They compare lifestyles. Moving now often means paying more every month for less house, less space, or a worse location. That emotional trade-off keeps people frozen in place even if life circumstances are changing. And this lock-in effect compounds over time. Each year that passes, fewer people reset their mortgages at current rates, which means mobility keeps declining instead of improving. This is why open houses can look busy, but deals don't close. People are looking, scrolling, calculating, but not committing. The market isn't lacking interest. It's lacking affordability clearance. Until incomes, prices, or monthly costs realign, the gap stays open. This also creates planning uncertainty. Buyers can accept a high payment if it's stable. What they can't accept is a payment that feels unpredictable. When insurance renewals jump unexpectedly or taxes reassess higher, confidence drops. And confidence is the fuel housing markets run on. This mismatch is why price cuts don't always trigger buying. A $20,000 reduction sounds meaningful, but if the monthly payment barely moves, buyers still walk away. Monthly math, not list price, is what decides activity now. Insert after market loses depth. In previous cycles, average buyers provided stability. Today, the market relies too heavily on a narrow group of strong buyers. That imbalance increases volatility. When fewer participants control activity, markets become easier to stall and harder to restart. Patience is useful, but preparation is more powerful. Know your numbers in advance. Stress test your payment. And remember, in frozen markets, flexibility is often more valuable than timing perfection. Housing cycles don't reset overnight. They unwind slowly, through pressure, adjustments, and behavioral change. The goal right now isn't pour a tea to predict the exact bottom, or top, just to avoid being forced into bad decisions while the system recalibrates. If you explain housing only through interest rates, you're missing the real story. The true breakdown comes from seller lock-in, affordability math, insurance and taxes, inventory quality, and credit shifts. Let me know in the comments which city or state you're in and whether you're a buyer, renter, or homeowner. In the next video, I'll break down the top 3 regions in detail. And if you want no hype, real mechanics housing analysis, subscribe, because this series is just getting started.